You ever see those headlines about a booming economy and just kind of think to yourself, booming for who exactly? Well, that's a huge disconnect we're digging into today. We're talking about that massive gap between what the official numbers say and what's actually happening in most people's day-to-day financial lives.
I mean, on the surface, everything looks pretty fantastic, right? The stock market's hitting all-time highs, unemployment is way down. So what is going on? What's the deal with this paradox? And why does it feel like the economy is booming, but for somebody else?
And this slide really gets to the heart of it. It's like a tale of two different economies. On one side, you've got all this record-breaking data, but on the other side, public sentiment is at rock bottom. You've got widespread financial anxiety. These two stories just don't seem to be about the same country. To understand why, we've got to look a little deeper than the headlines.
Okay, so this whole contradiction can actually be explained by something economists are calling a K-shaped recovery. Now, instead of everyone rising together like in a V-shape, the economy is actually splitting. You've got two groups heading in completely different directions. Let's break down what that actually looks like. So when you hear about strong consumer spending, where is that coming from? Well, it turns out a staggering 60% of it, 60, is driven by the wealthiest slice of the population. They are basically powering the entire consumer economy on their own, and that really masks the struggles of pretty much everyone else.
And here's the other side of that K-shape, the part pointing down. A recent poll found that a massive 80% of Americans describe their own financial situation as either weak or, at best, fair. This one number, it just perfectly captures that widespread feeling of being left behind.
So this division is absolutely crucial to understand. On that top branch of the K, you've got the asset owners, people who own stocks, real estate, things like that. Their wealth has been growing like crazy. But on the bottom branch, you've got the income earners, the folks who rely on a paycheck. They're just getting squeezed by inflation and watching the value of their dollars shrink.
Okay, so given this really strange economic picture, how are investors reacting? Well, it seems like they're only looking at the positive headlines. But there's this old saying on Wall Street, when everyone agrees, it's probably time to be cautious. And the data shows that right now, almost everyone is optimistic.
And recent surveys show this incredible wave of optimism. We're seeing 52% of professional money managers, the so-called smart money, are feeling bullish. And individual investors, they're right there with them at 46% bullish. And to give you some context, that is a huge flip after 9 straight weeks of pessimism from that group.
This brings us to something called the theory of contrary opinion. And the whole idea is that when sentiment gets this lopsided, when basically everyone is bullish, the market might be due for a short-term correction. It's a classic warning sign that things might be getting just a little too hot. All right, now looking ahead, what could possibly change this picture? Well, the answer really lies with the two most powerful financial engines in the entire country, and they might be getting ready to work together. We're talking, of course, about the Federal Reserve. They control interest rates, and the U.S. Treasury, which controls government spending. And the idea that these two giants could start coordinating their actions, well, that could be a major, major catalyst for the markets. The combination could play out like a 1-2 punch. First, you get the Fed starting to cut interest rates, which makes it cheaper for everyone to borrow money. Then, second, the Treasury steps in and deploys a massive amount of liquidity. We're talking cash, right into the economy. And the amount of firepower the Treasury has at its disposal, it's just immense. Right now, it is sitting on a cash balance of $1 trillion. No, that's not a typo. That is a huge amount of stimulus just waiting to be injected directly into the financial system.
So what happens when you mix lower interest rates with $1 trillion in government spending? Well, historically, that combination has been an incredibly powerful tailwind for the stock market. If this whole scenario plays out, it could create some very, very bullish conditions for stocks down the road.
And finally, let's zoom out to the global stage for a minute. There's this persistent story out there that the US dollar is losing its dominance, and it's usually tied to oil sales. But honestly, this story kind of misses the bigger picture. Yeah, we hear it all the time, right? If oil isn't sold exclusively in dollars anymore, then the petrodollar system will collapse, and it'll take the dollar's global power down with it. But to really get what's happening, we need to separate two very different concepts.
You see, the true foundation of the dollar's global role is something called the eurodollar system. And this just refers to the massive pool of US dollars held in banks outside of the United States. Think of it as the plumbing of global finance. It's what makes loans and trade happen all over the world.
So here's the crucial point. The petrodollar is just a nickname for one specific flow of dollars from oil sales. The eurodollar system, on the other hand, is the entire offshore banking infrastructure. It was around long before anyone started talking about petrodollars, and it is vastly larger and way more important.
So the dollar's top spot in the world isn't based on some deal about a single commodity. Its real power comes from three pillars: the unmatched depth of its financial markets, the sheer size and strength of the U.S. economy, and that global banking infrastructure we just talked about. And believe me, those pillars are not going away anytime soon.
So here's the real takeaway. We are living in a K-shaped world, where Wall Street's crazy optimism is clashing head-on with Main Street's anxiety. So the critical question becomes this: when that powerful 1-2 punch of government policy finally lands, where is it going to push an already divided market next?